Hey everybody, hope everybody's doing okay and staying safe and well out there. If you're new to the channel, my name is Jerry. I do share a lot of investing knowledge as I learn it. I'm a pretty recent investor, probably going on 2 years now, and been on the ups and downs, and I finally kind of leveled off and found my groove into investing. And I share with you a lot of my portfolios. If you look through some of my older videos, I'll do dividend updates every month. I do reviews on ETFs that I'm researching and some that subscribers request. So if you have anything you want to see, leave me a comment down below. Like, share, subscribe, do all that good stuff. I really would appreciate it. So what are we looking at today? Well, this was a subscriber request, and this ETF is SCHD. I know a lot of people are really into SPHD, but these two, one letter, the C and the P, really makes a big difference in in performance and the way they assemble this portfolio for SCHD. Now, it does say, the interesting thing about SCHD is right here, it tracks the Dow Jones US Dividend 100 Index. Now I looked, and there is only one ETF that tracks the Dow Jones Dividend 100 Index, and that happens to be SCHD. So what I wanted to look for, because this gives you a brief overview of the objectives of the fund, but I wanted to see is what SCHD uses or what the Dow Jones Dividend 100 Index uses to evaluate companies to put in that index. So what I did was I went to the methodology, that's a tongue twister, of the Dow Jones Dividend 100 Index, and we'll just go over this pretty quick. And I really like the rules that they set up here for the Dividend 100 as opposed to something like SPHD, where they really weight heavily on the high dividend payers. Now, the Dow Jones US Dividend 100 Index, the universe is defined as the constituents of the Dow Jones US Broad Market Index, excluding REITs. So if you do not want real estate exposure in the ETF you're trying to choose, SCHD may be one you could consider. Now, if you wanted real estate exposure, maybe you can, buy real estate investment trusts on their own as single stocks, or you can buy a sector ETF that holds or that tracks the REIT index. So the stocks that are included in this index must pass the following screens. This one's a good one. Minimum 10 consecutive years of dividend payments. So they have to have been paying their dividend since at least 2010. Minimum float adjusted market cap of 500 million. So they're not going to get some really micro, there'll be some small cap in there, but with 10 years of consecutive dividend payments, there probably won't be much in the small cap, and we'll go review that when we get over to the composition of SCHD. And third is the minimum 3 months average trading volume of $2 million. So there has to be a really active stock to be included. So the selection process is cash flow to total debt, return on equity, the dividend yield, and the 5-year growth rate. So all those are ranked. Every stock goes through this evaluation, and the highest scores get into the index and essentially end up in the ETF SCHD. So we'll go on here, we'll look at it. It's basically a US fund. It's a multi-cap, core, or blend. So what that means is it doesn't only look at large cap, it doesn't only look at mid cap. It will look at the entire index to figure out what's going to go into this fund. Now, the one thing with this ETF has 94 holdings, and the one thing about it, it is really heavy in the top 10. Okay, but if you look at the top 10, it's pretty healthy as far as companies go. You have Home Depot, Exxon Mobil, Intel Corp, Bristol Myers Squibb, Pfizer, Pepsi, Texas Instruments, Verizon, IBM, Coca-Cola. So very strong companies, legacy companies mostly, that have been paying dividends for a long time. But 44% of the fund is invested in those top 10. So you'll look at country exposure. 98.6% is United States, a little bit in Switzerland and UK. 87% of it is in large cap funds. 8.5% of it is in mid cap stocks. I said funds. It was large cap stocks, mid cap stocks. 3% in small cap stocks. And we look at the sector exposure. Consumer staples makes up 20% of the fund. Information technology makes up 18%. Industrials make up 17%. Healthcare is at 12%. Consumer discretionary is at 11%. Financials at 8%. Energy at 6%. Communication services at 4%. And materials under 2%. And you'll see in the style map, this is a large cap value fund. So they will look for value among the constituents. So that's SCHD in a nutshell. Who do I think this fits in well with? I don't know. The reason why I wouldn't suggest this as a core holding, for instance, like if this was the only ETF you were to choose, I wouldn't personally suggest it because of the very heavy weight in the top 10. This could be a good addition along with SPHD as well. I know a lot of people think I'm hating on SPHD, but what I mean about SPHD is I think it fits a portion of your overall portfolio, not your complete portfolio. So if you've got 10-15% in SPHD just for that monthly dividend income, I think that's fine. But to have 100% of your investing dollars in a fund like that, I think is a little short-sighted, especially with SPHD only having 50 stocks. SCHD is a little bit better, has better quality companies, but it still only has 94 holdings. So I still say this is great for somebody, for just a piece of your portfolio. I'd go higher on SCHD than I would on SPHD as far as percentage wise, but that is SCHD in my opinion. So I'm just some dude on YouTube. You guys got to remember that. And if we'll take a look, we'll look at some performance out of SCHD and we'll compare it to the S&P 500 and to SPHD. And we'll go on here to Yahoo Finance and we'll just look I have SCHD in the darker blue, SPHD in the purple, and VOO, which is the S&P 500 ETF, in the light blue. And you'll see in a 5-year period, you got 44% for VOO, 27% in SCHD, and 1.62% in SPHD. So the difference is you get a big fat monthly yield out of SPHD, but you know, that's going to be your return basically, or it has been for the past 5 years. And another thing I wanted to point out real quick, when I'm comparing things to S&P 500, I always like to compare it to an ETF. Some people do it otherwise, because anytime you have a ETF that tracks an index, the actual index will outperform the ETF every single time. So VOO tracks the S&P 500, but the S&P 500 actually outperforms VOO every single time. Why? Because of the expense ratio. So anytime you see VOO, it'll be underperformed just slightly the S&P 500. That was just a bonus that I just thought of just right now. So we'll look here on the ETF channel, and we will chart $10,000 invested. And between SCHD and VOO, it's pretty darn close. It really is. From October 2011 till the close of business on Friday, which was May 29th, you got a total return from SCHD of 161%, and out of VOO you got 188%. So average annual is a little bit over 1% better in VOO than it is SCHD. So I hope that was a good review. I hope you enjoyed it. If you have any questions about it, please leave them down below. Like, share, subscribe, do all that good stuff. I appreciate every last one of you. You guys have a great day, and we'll talk to you later. Thanks. Bye-bye.